Hey guys, this is Rudy coming to you live from Palm Beach in Florida. Previous video that I made, I covered some of the sort of top 5 small energy stocks related to a video that I had made before, which was the top 15 small cap energy stocks that you guys had picked. And then from that, I picked 5 and probably picked the wrong 5. But anyway, you guys can tell me. Anyway, I eliminated all the ones that were trading over the counter and ended up with just 5 of them. And, arguably based on the ratios and based on debt and based on the revenue that they're generating, the profitability, etc., they're all potential buys, right? So you see energy pulling back. And, sometimes I start my videos with 1 Maserati, 2 Maseratis, 3 Maseratis, depending on how much we lost on the day on paper. But I'm not doing that right now because I'm not too worried about energy. I think it's just a matter of time before we see a spike. You might not see energy, specifically WTI, back at $120 a barrel, but you could certainly see it at $90 or above as we get more closer into winter in the Northern Hemisphere. What I want to do with this video is actually touch on some of the larger energy stocks that are probably potential buys as well. Some of them I have spoken about before, so they're not going to be new to you. What I've done is I've done a comparison of 5 stocks, and a couple of them, so specifically Targa Resources and Blackstone Minerals, I have not spoken about before, ever. XLE, if you've been following my videos, you will know about, because I've talked about that one often. In fact, what I've been doing over the past couple of months or so is I've been putting my cash awaiting investment into XLE. XLE is now one of my largest energy holdings. It's not because XLE is better than anything else. It's not because it's going to give me a greater return than anything else. But money that sits idle is just losing interest and losing value because of inflation. Money is actually worth zip, So cash must always be viewed as cash awaiting investment. So from my side, I keep dry powder, so I keep some cash on hand so I can buy something if it pulls back sharply. And you might recall that just a couple of weeks ago, maybe just over a week ago, Petrobras pulled back to under $10 per share. And that was a buying opportunity. It was a screaming buy at that price. If you picked up some, all strength to you. If you didn't, too bad. You probably missed an opportunity to add some Petrobras to your portfolio if you already have it long at a really good price. But for now, what I'm going to do is I'm going to compare 5 different stocks. So what I have here is effectively 5 companies that are very, very similar, right? So I have EOG Resources. So the odd one out, firstly, is XLE because it's an ETF. An ETF is an exchange-traded fund, and the exchange-traded fund holds predominantly Chevron and Exxon, and then a whole smattering of really good companies, including EOG Resources. But if we look at these 4 companies here, we've got oil exploration and product, that's EOG. We've got oil field services, Schlumberger. First time I saw the name Schlumberger, I thought it was Schlumberger. But anyway, Schlumberger. And Targa, oil refining and marketing. Master limited partnership is always look at the master limited partnership because they pay a lot of dividends, but they might complicate your tax filings for you. And then I got another one here, which is an EMP master limited partnership. I've never spoken about Blackstone Minerals before. And that one came to me almost by chance because one of my friends said that the largest positions that they have in their family and friends and clients' accounts on energy right now is Blackstone Minerals. So they're like, I don't know anything about Blackstone Minerals, so I better take a look. So a couple of things here. For those of you who've been following my channel, you know I kind of go through the same routine here when I compare 5 different stocks. A couple of things that are interesting here is when we look at the 20-day raw stochastic score. This is for the technical gurus among us, right? So all the super nerds. If you look at the 20-day raw stochastic score, anytime it's over 80, arguably it's somewhat overbought. So none of these are overbought. In fact, the 2 higher percentages here is Schlumberger just over 50 and Targa just over 60. So in theory, based on the raw stochastic, according to bar charts, none of these are necessarily overbought. A couple of anomalies here because I'm always looking for outliers. There's a couple of changes of opinion. These are not significant. Like a month ago, 88% of analysts said buy, now it's 80%, whatever. This is immaterial, but look at this one. So Targa, A month ago, only 16% of people said buy. Now, 72% of the analysts say Targa is a buy. Now, if you're contrarian, you might say if the analysts had moved from 16% buy to 72% buy, then maybe I want to sell, take my profit and get out of it. Because these guys are wrong as often as what they are right. If you were long in any of these five, how have you been doing? So specifically here, I'm going to look at the 6-month return. XLE is pretty much flat over 6-month. EOG is down just a little smidge. Pays massive dividends, so this is nothing. Schlumberger up 10% is the outlier here, along with Blackstone Minerals, which is up 8%, and Targa also down just a little smidge. So there's not a lot to choose here, but you can certainly see that Blackstone Minerals and Schlumberger have outperformed the other three. We look at the key statistics. So what I'm looking at here is the annual sales, and then comparing that. So you can't compare annual sales for XLE because it's an ETF. The exchange traded fund doesn't have sales. That's why it's zero. It's a $43 billion market cap, but look at the others here. So EOG is generating approximately 18 billion in sales, got a market cap of about 81 billion. Schlumberger, almost 23 billion in sales, a market cap of, relatively speaking, only 74. And then here's an interesting one, right? Targa, generating almost $17 billion in sales annually, and its market cap is only 17 billion. Interesting, huh? And this one, Blackstone, interesting too, 359 million in terms of sales, market cap 3.8. It's kind of more sort of realistic or more, shall we say, normal. In terms of ratios, right now the S&P 500 average price earnings ratio is around 14.2 or so. So we want to be at 14 or below if we use the PE ratio as a benchmark or metric in terms of deciding whether it's a good time to enter or open a new position, or maybe add to an existing position. You want to be at 14 or below. So Schlumberger and Targa, based on PE, right? There's only one metric, but they kind of disqualified you because the price earnings ratio is too high. The other three are very well priced. I mean, XLE at PE ratio of below 7 is a steal. In days gone by in the market, we used to say it's a screaming buy. Now I'm so nervous to say anything's a screaming buy because you might lose money, right? So we don't want to go there. We'll just say like, this is really, really well priced. It's on sale, okay? EOG, PE of only 10. Blackstone Minerals, a PE of only 12. As I said at the start, I don't know Blackstone Minerals. If you were long in any of these five, man, you've had a good year. This is a 1-year chart, as you can see here at the top of the screen. And here you can see the performance over the past year or so. The poorest performing stock is Targa, and it's up 40%. So, I mean, if your poorest stock is up 40%, you're probably smiling all the way to the bank, right? Assuming you also took some profit along the way, because remember, no one gets poor taking profit. How about this Blackstone Minerals? So I want to do just a little bit of a deeper dive on this one because I don't know it, right? So maybe we can do some due diligence together here and decide whether Blackstone Minerals Limited Partnership is actually a buy or not. So this snapshot is a couple of days old, so I don't know what it's trading at currently because I'm not day trading. But this is from December 5th, and today is December 7th, so it's 2 days out of date. You could buy Blackstone for about $17.82, so 18 bucks. It's a $3.7 billion company. It's got a PE ratio of below 10. Pays an enormous dividend. So at its current price of $17.82, which was on Monday, that dividend of $1.80 is yielding almost 10%. You know, for old guys like me who invest for fixed income and for dividends rather than just growth, holding something like this as a foundational stock is not a bad thing when you can sock away 10%. Whether the dividend is sustainable or not is a separate issue, which requires a little bit of a dive into the fundamentals of the company. I'm going to get into a couple of screenshots just to give you a highlights overview in just a minute. And it's sitting here just to the right of center on its 52-week range, which was about 10 bucks. But the high was only 20, so it's trading quite high. I'm not sure what Blackstone is trading at today. I should probably take a look. But anyway, by the time I take a look, you've beaten me to it. So let's just take a little bit of a deeper dive here. So look at the valuation. And we know that the price earnings and the price to book is the most appropriate because Blackstone has positive earnings. So if we look at the respectively price earnings ratio for the trailing 12 months. So we're looking for TTM, it's trailing 12 months. And we can see Blackstone's PE at around 10 is sort of in line with the industry, which is about 9, which means that there are some cheaper buys in the industry, including, of course, XLE that I just mentioned a minute ago. About price to book. Price to book, we look at the most recent quarter, and it's smack bang in line with the industry, 4.6, 4.6, right? So it seems a little bit expensive in terms of price earnings, but it seems like a fair buy. How about profitability? So based on its gross margin, the operating margin and net margin, Blackstone converts a larger percentage of its revenue to profits than most other companies in the oil and gas industry. So how much? The gross margin for the trailing 12 months for Blackstone is 87%. The industry is only 34%. But it's also managing its expenses exceptionally well because the operating margin is 70% and the industry is only 19%. And look at the net profit margin for the trailing 12 months. So for the past year, Blackstone has been making an enormous profit, almost 70% compared to the industry's 3.31. And we're talking about the oil, gas, and consumables fuel industry here. So if the average or median for the industry is only 3.31, given the fact that the oil prices were so high over the last year, then arguably they haven't done a really good job. Now, to be fair, many of them did a really good job in terms of balance sheet repair, paying off debt and things like that. So they've done some really good things, cutting operational costs, making sure that they pull back on that very generous spending binge that they were on over the past couple of years or so, excluding obviously the time during the pandemic and shortly thereafter. But this is phenomenal. If you look at the profitability of Blackstone compared to the industry, it's a phenomenal outperformer. How about financial strength? Now, you guys know by now, I always look at debt, right? Blackstone's debt to capital ratio is only 5%. It says it's in line with the oil, gas, and consumables fuel industry. It's nowhere in line with the oil and gas and consumable fuels industry. How do I know this? Well, it tells me. Firstly, right at the top here, this particular slide, which I took from Schwab, says it's in line with the oil, gas, and consumable fuels industry norm, but it is not. The total debt to capital ratio for the industry is almost 37%, and Blackstone's only 5%. In addition to that, they've even been reducing the debt just a little, just a tiny little smidge, but they arguably almost have no debt. So if you look at Blackstone and you look at the interest coverage, I mean, this is crazy stuff, right? The interest coverage ratio is 101, 102 almost. The industry is only 13. So Blackstone, to me, looks like a really interesting sort of larger cap stock that you might want to get into. Everything about Blackstone, I haven't done a deep dive into the balance sheet, and usually I would at least do that and probably look at the 8 and 10 filings for the quarter just to kind of make sure that I'm going down the right path, right? So I don't want to trap myself here and put money into something that's the proverbial equivalent to catching a falling knife, right? This slide here is from Tip Ranks. They have Blackstone at an outperform. It's a 10. Pretty much any metric they use is all green, right? It's all positive. You can see pretty much all these green arrows here. The average target price about $20 or so. So there's a little uptick there as well, in addition to that very juicy dividend. So when you look at this Blackstone as a potential buy, so on this particular video, I'm sharing 5 stocks with you, and there are 3 of them that are probably a little bit less interesting to me than the other 2. So those 3 would be Schlumberger and Targa and EOG Resources. Nothing wrong with them. They're just less interesting to me than XLE for different reasons to Blackstone. Blackstone looks like a potential solid investment, but we do need to do a little bit more due diligence before we open a new position in any stock, in this particular instance, Blackstone. XLE for me is like a no-brainer, right? It's cheap. The energy prices right now, like the futures on WTI at $74 or whatever, is also cheap. But watch this space, right? It's not going to stay there for too long. It might even go lower. It doesn't matter. It'll go up again. But I don't think we're going to see WTI at $40. I may be wrong. That'd be scary. But yeah, I don't think so. But XLE is like a no-brainer. You got an ETF that is 20% invested in Chevron, 20% invested in Exxon, approximately it's 40%. Then you got the next 5 stocks or so, 6 stocks that it holds, where the positions are about 3 or 4% in terms of weighting. So if you take the weighting of those smaller stocks, which includes, for instance, your favorite mine, Occidental Petroleum, but if you take those, let's call it 6 stocks at around sort of an average 3.5%, 4% or so, that's like another 20 something percent. So 20% Exxon, 20% Chevron, 20% a handful of others, it's already 60, 70% of XLE, just spread across diverse industry, E&P, energy stocks. That's like a no-brainer. Of these 5 stocks that I just shared with you, as I said, 3 of them are less interesting to me: Schlumberger, Targa, and EOG Resources. Blackstone looks to me like a potential buy. If you're long in Blackstone, let me know why. If you think it's a buy, tell us. Maybe share with us. Let's see if we can help one another to make some money in this declining energy market. For now, this is Mr. Roxy signing off, saying thanks for watching. Bye-bye.